I'm Heather Houghton with Oil and Gas Investor. I'm sitting with Troy Eckerd, CEO and manager of Eckerd Enterprises. Welcome.
Thank you so much.
So first of all, you've been raising capital in private investor markets since 1985.
Right.
What do you think is different today?
Well, I think there's a lot of things that are different. The first fundamental difference is that the information flow is substantially higher than it ever has been. And so I think it's almost to the point of information overload. I call it Google smart. So no matter what you're doing with private investors, they can go to any source they can find online and they take it as the gospel. So what I think is hurting the capital markets is that you no longer have the ability to put a technical team together and say, you know, we found a great asset to buy. The private equity, the private partners, they want to go in and try to disassemble it, and they want to try to figure out if they're smarter than you. And what that's done is it's kind of taken the ability of capital providers or capital managers' ability to lead the horse. So it's a lot different than it's ever been in the last 30 years.
So how do you think private investors evaluate their investments, the public perception of the industry post-collapse, and their opinions going forward?
Well, I tell you, it's been, this last 2 years, in my opinion, has been the worst downturn in 31 years of my career. And the main reason it was so dramatic is that because the shale plays are so expensive and they're so broad in geographical dimensions, that you have major oil companies putting billions of dollars in. And so the smaller private equity investor said, well, I'm just going to get on this elephant and ride it. Surely this bull elephant knows where it's going. And what happened to the private equity is they got enamored, they fell in love. And so from 2009 through 2014, everybody's all on board, everybody's investing, and then all of a sudden the elephant went off the cliff and everybody's saying, wait a minute, the smartest, brightest companies on the planet could not project or see or indicate that there was going to be a downturn, maybe a slight downturn, but not a complete global collapse. And I think the difference is that from the private equity or the private investor's perspective, the problem they have is that they're always wondering, how do I trust the people who are leading the pack before I put my money in, whether it's bonds, debt, equity, private stock, public stock. They're sitting back today saying, how could anybody not have known this ahead of time? It's very confusing to them. And when you have confusion, it creates paralysis. And that paralysis means, I'm going to wait. So I think the entry of private investors back into the market is going to be long foregone. It's going to be quite a while until they really get back in the market because they don't believe the people in charge really know where price of crude oil is going and what that looks like over the next 2 to 3 years.
Yeah.
It's a lot different.
It's really interesting. How important is the private investor market to the oil and gas industry, and does the industry recognize this capital partner the way it should?
You know, this has been the most interesting part for me in my career is that it's like somebody selling watermelons, and the guy that grew the watermelons and took care of them and grew them from seeds, he took all that risk to get that watermelon ready for market. And the customer says, I want to buy that watermelon. I really could care less all the labor you went into it. I just know that I can buy a watermelon from you for 50 cents, the other guy's selling it for 25 cents. So the private investment market is always worried about value to themselves. And I think the problem is that the market perception going into the shale plays 7 years ago was that we're going to get a really good bang for our buck. We're going to get in these massive shale plays. We're going to be able to participate in multiple wells. We got high well density. And when that all came back to roost, including like with our company and with our investors, is we saw these major oil companies start sending us out jibs and invoices saying, well, we told you the well was $8.5 million, it really was $12 million, and by the way, here's your cost overrun 2 and 3 years later. So the investors not only got enamored and they wanted to be involved, but then they got a price collapse followed by, in my opinion, an abuse of mismanagement without having good communication. So I think that the investors have said, look, I don't know how I can get in. I don't know if my money means any significant amount. And what I know is that the bigger companies really could care less about private equity. I think that applies to people who own their stock. I think that belongs to people who put up debt. And I definitely think it belongs to those of us who got directly involved as a direct working interest owner or direct participant.
So speaking of shale plays, do you think private equity will stick with shale plays, and if so, which ones?
Well, I've always said follow the rigs. And so what I thought was interesting, the dynamics the last 7 years, everybody kept arguing, you know, is the Bakken better than the Eagle Ford better than the Permian, et cetera. We've got the Utica. And I said, you know, the real thing you have to follow is the drilling rigs, because the person that's guiding that rig are the economists, the CFOs, the engineers, the geologists, and geophysicists who are saying, out of all the hundreds of thousands of acres we own, this is our sweet spot, this is our best acreage. So we're at 1,900 rigs, the price starts to collapse, and like an accordion, those rigs disappeared, and all of a sudden we get down to 416 rigs about a year ago, And all you have to do is look at that map, and now you know the most cost efficiency of operations and drilling, the best plays in the country. So 75% of all the drilling rigs active a year ago, or even 6 months ago, were in Texas and Oklahoma. Okay, so we now know that the Barnett, the Utica are not really that economical. So from my standpoint, when I look at the shale plays, it's going to be a reverse of that according effect. If I knew where they collapse and I just do a reverse mapping and timeline, I know what plays are going to be the last to be productive. I think it also has to do with midstream. The fact is that a lot of these plays did not have infrastructure. And what was recognized is that when you have $100 plus oil, you can have an allowance of $10 a barrel to haul it from North Dakota. Today you can't do that. Today you have to be so cost efficient, so they're drilling in Texas, they're drilling in areas that are close to markets to get their product sold. So the shale plays to me are going to be Permian, Delaware Basin, Oklahoma, probably Colorado. The Bakken's up to 31 rigs, but that's a long time coming. It's just too remote to make sense unless we're over $80 a barrel.
So looking in the future, where does Eckerd Enterprises see the oil market today and then 24, 48 months from now?
Well, I've always been an optimist my entire career. You have to be in energy. You have to always think positive. But about 3 years ago, I started feeling like that we way had the balance of economics. My background is economics and finance, and what I realized is that all you have to do is apply the numbers. And so, for example, when we were at 1,900 drilling rigs, we were putting out X number of wells per month. We had X number of barrels to each rig. And then all of a sudden, we collapsed to 416 rigs, 76% implosion. But here's an interesting statistic. If that's true, then why didn't the production output drop from 9.5 million barrels to, let's say, 7.5 million barrels? It didn't. It dropped about 700,000 barrels. Why is that? Because they took the best rigs that were available and they put them to work with the best crews. So a rig today is really drilling the equivalent of 2 to 2.5 wells. We're really drilling like we have 1,500 rigs. So I look at the price as being really sitting on the line. It could just as easily go back to $43 a barrel, because once all these new rigs online bring on those 1,000 barrels a day wells, we could easily make up that 700,000 barrels. The flip side is if Iran keeps on doing what they're doing, they'll be back in sanctions, and 9 to 12 months out, we'll see 2 million barrels come out of the market. We're back to $85 to $100 a barrel. So if you're smart about the way you play it, I would play it at 53, going to 43. Anything above that is an upside and expected bonus, because we can't control something that's out of our control, which is international politics. Can't do it. So I'm looking at $53 a barrel, maybe to 60 over the next 12 months. I would think by 2020 we should be back to 75 to 85. Other than a major geopolitical event, I don't see what's going to move it beyond that. It's just my opinion.
So we've all heard on the news, the middle class is disappearing. In your opinion, do you think the middle class of oil and gas investing is disappearing?
I think that started about 10 years ago. When the first shale wells came out, you could put $500,000 into a well, maybe you own 10, 20% of the well. But when well costs started getting to be $3.5, $5, $8, $12 million per well, private equity, private investors would say, well, I want to put $500,000 into a well. Well, great, you're going to get 4%, you're going to get 8%. So this last downturn really signified the financial separation between private equity and majorly public funded companies, right? And I believe that middle class is disappearing. You look at the trade show floor today, it's mostly us in the business. 7 years ago, you had private investors in your private equity groups. They're not here because they're saying our money can't carry enough financial clout, so therefore maybe we're in the wrong game. I'm afraid we've run off a lot of the middle class and they decided I just can't play anymore.
If you were talking to someone looking to invest in the oil and gas industry, what advice would you give that person?
Well, back to my Google Smart comment. The problem is that investors have changed so much in the last decade. Now somebody thinks a long-term hold means I bought a stock at 8 o'clock on Monday morning, I held it to 8:15. There you go, that was a long hold. We now have investors who believe everything is instantaneous because the internet's instantaneous. Oil and gas is a 5 to 20 year investment. When you make an investment in a well that's going to last 30 or 40 years or 7 or 10 years, you can't expect to invest, have results, have a check, get paid out in 36 months. It's not possible. What is possible is that it takes 2 to 3 years to put together an idea, it takes 12 to 24 months to implement it, and maybe it takes 12 to 36 months to get economic benefit. So what I would tell an investor is, whether it's stock in a company that drills wells, a stock that's an E&P company, so maybe a service provider, is you got to invest over a 5-year period. Our cycle is very, very patternized. And if you look at the dollar and oil and gas prices, they're so parallel in opposite directions. If you just look at the pattern, it's easily a 5 to 7 year pattern. The minimum time frame has to be 7 years. If you do it any less expectation, you're a day trader, you're really not in the energy business, you're a stock trader. And as far as private equity, the same thing. I write my check, I entrust the people I put my money with, I sit back and I let them do their job. My expectation is that I'll get my money back as I should over time, over 5 to 10 years.
It's always the hope, isn't it?
It's hard, you gotta be patient. I'm not good at patience, but it's what I've learned.
Well, thank you so much for joining us.
Yes,
This has
ma'am.
been really
I
interesting.
appreciate it. Thank you for having me on. I appreciate it.